Anyone that's on Medicare or going on Medicare will find that there are multiple insurance plan options available. But today, the most popular supplemental option is the Plan G. So in this video, I'm going to show you the 7 reasons why Plan G might be the best choice for you. The first reason is because Plan G can be a guaranteed issue policy. Let me explain what I mean by that. Guaranteed issue simply means that there's no underwriting required. There's a period of time in which the insurance company has to issue the policy. If you make application within that period of time, they will issue it. No health questions asked. All pre-existing conditions are going to be covered as well. And so when we first go on Medicare at 65, and let's just simply say that someone has a birth date of 7/15/1958. And they decide to go on Medicare at 65, they will be eligible for Medicare. They'll have an A date and a B date of 7/1/2023. Okay? And so in this scenario, when we talk about guaranteed issue has everything to do with the B date of your Medicare coverage. So what happens is 6 months prior to my B date, we can apply for a Plan G and it will be approved to be effective 7/1. But there's also an additional 6 months beyond the B date where we're in what's called our open enrollment period for a Medigap policy. Okay? And again, that lasts 6 months. So we can apply 6 months before we start Medicare, but at this point in time, we're still in our Medigap open enrollment period for 6 months. That would be July, August, September, October, November, December in this example. And that would simply mean then in January 1, 2024, I'm no longer in my guaranteed issue period, and now after that, I may have to go through underwriting to get that Plan G. So the point is, when we first go on Medicare, we have this Medigap open enrollment period, we're in that guaranteed issue period of time, and you can absolutely get that Plan G regardless of your health conditions, regardless of any pre-existing conditions you have. That company will issue the policy. Now, let's just change the scenario real quickly so you're real clear. Let's say that someone does have a birthday 7/15/1958, but they decide to keep working and they do not enroll in anything other than Medicare A only. And then let's say they work for 2 more years and they pick up B at a later date. That's called the special enrollment period. And now we have a 7/1/2025. Now their guaranteed issue period, remember, because it's tied to the B date, is going to be different. It's going to be 2 years later. So again, then this would be, they have all the way until January 1, 2026, because we start counting the months here, July, August, September, October, November, December. We're still in that period of time for 2025, and then after that, we'd have to medically qualify. So my whole point is that guaranteed issue period is always going to be tied to your B date, so you can get that G policy if you'd like to. During that period of time, no underwriting. The second reason Plan G is accepted by most healthcare providers. When you get a supplemental plan, supplemental plans follow Medicare. So we encourage all of our clients, anytime you're going to see a provider, and by the way, I do want to emphasize most. I'm not saying all, but the great majority of them. So all you have to do is ask this: do you take Medicare? Do you take Medicare? And that's the only question you have to take. If you get a supplemental plan from United Healthcare, from Aetna, from Cigna, from Humana, from Mutual of Omaha, from whoever, doesn't matter. You don't even have to ask the provider if they'll take the plan, because if they do take Medicare and they say yes to that question, they absolutely will take your supplemental plan of choice. Whatever letter you choose, whatever company you choose, they are going to take that. So we never have to worry about them taking your Plan G as long as they take Medicare. Now, if they don't take Medicare, then I'd find a different provider. But again, the majority of providers are going to take Medicare, therefore they will take that Plan G, which almost gives you unlimited options for providers, for hospitals, for doctors, for specialists, for surgeons. Almost everyone takes Medicare. Therefore, they'll take your G plan. Hey, just real quick, we often hear from our viewers that they wish that they would have seen a video earlier because they made a decision that really wasn't in their best interest, or they made a decision without having this information and it cost them financially. And we don't want that to happen to you. We upload 3 times every week, and the only way you're going to know about our new videos is if you subscribe to the channel and hit the bell notification. We're constantly giving away brand new strategies, updates, and comparisons that you don't want to miss. So click the subscribe button below this video right now and turn on notifications so that you never miss another video. The third reason is that Plan G is, notice, almost full coverage. Not quite full coverage, but almost full coverage, all right? So the point is there's not going to be any surprise bills. You're going to know exactly what you're going to be responsible for on an annual basis. So whenever we enroll in a Medicare A and B, we know that Medicare A and B pays decently, but there's always some gaps. And so what we have on the A side of Medicare, which is your inpatient side, and the B side is your outpatient side, as well as all doctor services, whether that's out or inpatient. What we have gaps, all right? And so what happens is we have 6 gaps. The first gap on the A side is a deductible of $1,600. Now, that deductible can happen more than once in a year because it's tied to a benefit period. So that can happen, 2-3 times a year if someone keeps getting rehospitalized. So that is my first gap. The second gap is for extended hospital stay. So if I'm in the hospital longer than 60 days, it will cost me $400 a day copay month 3, and then they double it to an $800 a day copay month 4 and month 5. Very expensive for extended hospital stays. They don't happen often, but when they do, they're expensive. And then the third gap on the A side of Medicare is for skilled nursing facilities. And what this means is days 21 to 100 will cost me $200 a day copay to the skilled nursing facility. The first 20 days, Medicare covers full cost as long as we're in the hospital 3 full days prior. Then we go to skilled nursing, all right? And then after the 20th day, then we have to start paying a daily copay. Those are your gaps on the A. Let's talk about the gaps on the B side. We also have 3. We have a deductible this year of $226. Now, that one is just once a calendar year. That one can happen multiple times, but this one just once a year. And then the second gap, remember, Medicare pays 80% of everything on the B side, but you pay 20%. That's called coinsurance. So that is your responsibility. And then number 3, there's a possibility of a doctor adding to the bill. It doesn't happen often, but it can happen. And that's when a doctor adds 15% to the Medicare approved amount. In other words, they won't take Medicare reimbursements as payment in full. So a doctor that does take it in full, that's called an assignment doctor or participating doctor. This is a doctor that adds excess, non-participating, and so you would have to pay the 15%. So you can see 3 gaps on the A and 3 gaps on the B. So when I talk about Plan G being almost full coverage, here's what I mean by that. It will cover all your A deductibles. You go to the hospital multiple times, it's covered. If you have an extended stay, it covers month 3, month 4, and month 5, all your copays, plus it gives you 365 days additional beyond the 150 in the hospital at 0 cost to you. Number 3, it will cover all 80 days in the skilled nursing facility, so that wouldn't cost you a penny. So every gap is covered on the A side as long as you're going to a provider, a skilled nursing or a hospital that takes Medicare, you have full coverage. Over on the B side, here's what it doesn't pay. It will not pay, your G plan will not pay your B deductible. Remember, it's once a year, so the first $226 would be out of your pocket. The only plan that's going to cover the B deductible today would be the F plan and the C plan. Those are the only ones, Med Sup plans, and those are being phased out anyways. But the point is that would be out of pocket for you once a year, and then that number resets every January. Now, last year that actually was up. It was at $233, so they lowered it $7. But it's historically been very low. They keep it low on purpose, so you would have to meet your B deductible. All right, and then it'll pay your full 20%. It'll also cover excess charges if you happen to go to a doctor that adds to the bill. So as you can see, that's why I'm saying people like the G, because it's almost full coverage. We know exactly what we're going to be responsible for on an annual basis. Whatever the B deductible is going to come out of my pocket. And after that, as long as Medicare pays first, G plan fills in all 5 of the 6 gaps that remain. The 5th reason is that Plan G offers long-term rate stability. Now notice what I say here. I'm saying it offers. We have found that some companies tend to be more rate stable than others. And let me explain exactly how this works. When you buy a supplemental plan, here's what's happening. You are going to go into a group. Now, in most states, your initial premium is going to be based upon your age and your gender and where you live, your zip code of your county, sometimes tobacco, but usually not. But it's usually just age and your gender and where you live, zip code. And so that's what determines our initial premium, all right? And so whenever we quote insurance rates, we have a variety of ages, of course, because people retire at different times. So the insurance companies will give us rates from 65 to 105, sometimes below 65. Some states offer supplemental plans for people that started Medicare on disability, so they may be 50 or 57 or whatever. But as a general rule, rates are always going to be available from 65 to 105. And then we're going to have female rates, male rates, non-tobacco, and tobacco rates. And so let's just say that we are a female at 65, and let's say our initial premium is $125. Okay, that's the initial premium that the company is going to charge. And again, companies charge different amounts, but they're normally very, very close to one another. So what's happening is you bought a plan and you're going into a group. Now, in some states, what happens is you're going to be what's called an attained age state. Attained age means that your initial rate's at 125, and then when you turn 66, we're going to see a slight increase to that premium. You've attained another age. And then at 67, it's going to go up a little bit as well. The reason for that, and by the way, that's typically $4 or $5 a month on an annual basis. So not a whole lot, usually 40 or 50 for the whole year, divided by 12. And so we're going to see that up. The purpose of that is to offset some medical inflation that's occurring in the market because, all things go up. And so that's going to happen in an attained age state. Now, some states are called issue age states. And that simply means that rates are not going to go up every year because you've attained age. They write the policy and you pay a premium based upon what age you are when the policy is issued. Now, in comparison, issue age, that's probably going to be maybe initially $145. Going to be a little bit higher, maybe $135, because they're not going to raise those up on an annual basis. So they start typically a little higher. Most states are attained age. Now, you may happen to live in a state that's called community rated, and that even would be higher then, and that means that everybody, regardless of age, regardless of gender, regardless of where they live, if they live in that general area, they're all going to get the same rate. That's called a community rated group. All right, but again, most are attained age throughout the country. And so here's my point. We're talking about long-term rate stability. So a company gives you an initial premium. That's what you pay when the policy is written and you're now in this group. And so what's happening is in this group is that all the policy holders are paying in their premium. You're paying that $125 a month because you want to get rid of all the liability other than what? That B deductible. So they're going to have to pay the A deductible, the extended co-pays for hospital skilled nursing, the 20% coinsurance excess if it occurs. So you have to pay them a premium to take the liability. So you pay in, and all the policyholders in your group pay in the premium, and then the company has to pay money out, right? We call that claims. You transfer that liability, so they're paying those hospitals and those doctors and all those kinds of bills. And so what happens is in every state in the country, what happens is eventually in every group, claims are going to exceed premiums. As long as premiums are covering all of the bills that are going on in the group, all the claims, they're not going to raise the rate other than if you're in an attained age state, they'll raise a little bit to offset inflation. But in all these rated possibilities, eventually claims exceed premiums. When that happens, that means that company's losing money. So let's just say they're losing 5%. Right, so that 5% is a loss. 95% of the claims are covered by premium. Now they're losing, and they're protected by insurance law. They don't have to lose money. So what they do in every state, they're going to take this 5% loss, and they're going to talk to the insurance commissioner of that state, and they're going to appeal and request for a rate increase for the whole group of 5%. And so their job is to protect the consumer, to make sure this rate increase is justifiable, it's in line, paperwork is filled out properly, and if they approve that rate increase, what happens? Everybody in the group goes up 5%. Now, you could be in the group and maybe never had a claim. You're going up 5%. Another person's in the group and they're in the midst of cancer and they've cost the group $100,000. They're also just going to go up 5%. So that 5% is equal to everyone that's in the group. And here's my point. When we talk about rate stability, we know that all rates are going to go up, but some companies tend to have these group increases more frequently and more drastically. And the reason for that, it's the size of the group. There are some companies that have very large groups. They keep those groups open for a longer period of time. We as agents fill up the groups. So the longer the group is left open, the more rate stable it's going to be, because why? We have more policy holders that are in the group. Some companies are going to have a smaller group and some even a smaller group still. And so what we focus on as a company is not just the initial premium. Yes, I care about that, but I care about how has this company performed in the last 10 years? How many rate increases have we seen? How stable have they been? Because that's really what's going to matter. And so the point is, we have the possibility of rate stability as long as we have a group that's much larger, the risk is spread out more, and it will be stable. So again, that Plan G offers that rate stability. And so what we do when we work with our clients, we look at the history of the rate increases of all the companies, because we want to make sure we go with a company that historically has proven to be rate stable, because we believe in the future they will continue to be very stable with their rates. Hey, if you're finding this video helpful, I want to invite you to go right up here and actually click on a link that will allow you to watch what I call the Medicare Essentials Workshop. It's a workshop that I did that really is going to show you everything you need to know about Medicare from A to Z, how to enroll, when to enroll, and the plan options for you. So go to that link and check it out. Now, the fifth reason is that Plan G is a portable policy. Anytime you buy a Medicare Supplemental Plan, it will be portable. Portability simply means this. Let's say that I live in Dallas, Texas, and I get transferred from my job, or I retire and I want to go be with my kids, and they live in Miami, Florida, right? So what happens? I'm going to move to Miami, Florida, and I have this Plan G. Well, that Plan G can be taken with you to Miami, Florida. All right? In other words, that cannot be canceled by the insurance company because you relocate. And so what's going to happen, now there is a possibility if I move from Dallas to Miami that they could raise my rate in Florida if rates are normally higher than what they would be in Dallas. That is a possibility. And again, we're a nationwide company. I've had people move all over the place, and I can tell you no one's ever canceled a policy whenever they moved because of an increased rate. That's never happened. So there's modest increases. Sometimes they're going to be all the same. But the whole point is, because it's portable, you can take that wherever you want. And that's what you need to keep in mind when you get a Medicare supplemental plan. It is tied to you. It's portable. In fact, anywhere in the 50 states and anywhere in U.S. territories, that policy and coverage is the same. Okay, unlike an Advantage plan, which is tied to a service area. If I move from Dallas, Texas to Miami and I have an Advantage plan, I'm going to have to get a totally different plan, pick out totally different doctors. Everything's going to change because those policies are not portable. But when it comes to the Plan G, it will be portable. Take it with you. Worst case scenario, they may adjust that rate a little bit, but it is still your policy. It can never be canceled because you moved. And that brings us to the sixth reason why Plan G is the most popular, and that's this. Plan G, notice, can never be canceled by the insurance company. Now, you may notice this, I don't know how big it is, but I got a little asterisk over there because there is one way in which an insurance company can cancel a policy, and that is for what? Non-payment of premium. Non-payment of premium. All right? And so that's the only way. So this can never be canceled, asterisk, unless you don't pay for it. Then they can. In fact, the way it works is this. If you miss a payment or you have a bank draft that doesn't go through, they give you 30 days of grace, all right? And they will notify you by mail letting you know the payment was not made and you need to make your payment before the grace period expires. And if you have not paid it during that 30 days of grace, then that company has the right to cancel your policy. And then you'll receive a letter called a reinstatement letter. They'll reinstate it, but you have to go through underwriting typically to get the policy back. All right, so when I say it can never be canceled, that is true, other than non-payment of premium, which means what? They cannot cancel it because of your age. You can live to be 120 and you still get to keep your policy. They can't cancel because of age. They also can't cancel because of claims, meaning, let's say, and I hope it didn't happen to you, but if you go through some serious health issues and you've had cancer or different things going on and you've cost them hundreds of thousands of dollars, they can't cancel because of that. You know, what's interesting, your auto policy can, your homeowner's insurance can because of claims, but not when it comes to Med Sup plans. They cannot be canceled because of your claims. The only way they can cancel it is non-payment of premium. So that policy is yours for the rest of your life, regardless of where you live. It's totally portable. It's written for life. It's truly a permanent policy. Now, just a word of caution here. I have had people, what has happened is, let's say you're doing, by the way, I would do this anyways. Definitely you want to pay with an ACH, okay? Yeah, if you're on a direct bill, it could be dangerous. You could miss the bill. And so an EFT, electronic funds transfer, an ACH, have it set up on a monthly bank draft. And I have had people that move. Let's say they move from Dallas, they're moving to Miami. They closed out their bank account in Dallas and they moved to Miami. And what they forgot to do was notify the insurance company that they have a new bank account. So if you happen to do that and change banks, by all means, as quickly as possible, notify them. You can just call them, customer service, and let them know, hey, this is my new routing number, this is my new account number, and that policy would just continue to be drafted just out of a new bank account. Okay, so don't let it lapse because you change banks. I've seen it happen. It's really sad, and if you wait beyond 30 days, then again, they will only reinstate it after you've gone through underwriting. And then lastly, Plan G gives people peace of mind. and all those other reasons that I just mentioned for you, all the benefits of the Plan G. Help people to know, number one, I'm not going to have any kind of surprises financially. I'm only responsible for the B deductible once a year. We know that you can go to any provider that is going to take Medicare. If you choose a company that is rate stable, meaning they have a larger market share, more policyholders, then it will be rate stable for the long term. We also know that if you move, take it with you. We know that as long as you pay the premium, you can keep the policy for the rest of your life. So that's what gives people peace of mind. And when you go on Medicare, that really probably is the most important thing, knowing for sure that you have a good plan, a good company that's going to take care of you for the rest of your life.